Hello and welcome. I'll be presenting an analysis of Berkshire Hathaway's acquisition of Precision Castparts Corporation, or PCC. This project walks through the valuation, capital structure, and risk considerations behind one of Warren Buffett's largest ever acquisitions. Berkshire Hathaway sat on over $100 billion in cash, largely because Buffett struggled to find acquisition targets big enough to move the needle. PCC, an aerospace and power components manufacturer, became that target. The analysis centered on three questions. Was the $235 per share offer a fair valuation? How should BRK finance the deal? And what market risks come with PCC's industry? The recommendation from this valuation is to acquire PCC at $235 per share, financed primarily with debt. The analysis started with a comparable multiples analysis using P over E, EV over EBITDA, and EV over revenue. Four companies, Rolls-Royce, GKN, Meggitt, and Triumph Group, had extreme or negative ratios that skewed the data, so I removed them as outliers. That single adjustment dropped the implied EV/EBITDA share price from over $5,000 down to $188.48. A number that suddenly lines up with the valuation methods in this analysis. Next, I built a discounted cash flow model using a WACC of 9.44% and a long-term growth rate of 1.5%. Projecting free cash flows out to 2025 and discounting them back gave an implied share price of $189.28. Compare that to Buffett's actual offer of $235, and you can see that the roughly 19.5% premium he was willing to pay. Because small changes in assumptions can swing a valuation significantly, I stress tested the model across a range of WACCs and terminal growth rates. The highlighted base case sits at 189.28, but you can see the green zone, where assumptions push the implied price closer to Buffett's $235 offer. This shows the offer is defensible under reasonably optimistic but not unrealistic conditions. With the price settled, the next question was how to pay for it. Using the Miller model, I found that financing the deal with about $25 billion in debt rather than cash increases BRK's firm value by roughly $5.35 billion. That's because the corporate tax shield on interest payments outweighs the personal tax disadvantage of debt. The recommendation is to finance this acquisition primarily with debt. One specific decision BRK faces post-acquisition is what to do with PCC's military aircraft and aerospace division, which carries real downside risk. I modeled a 35% chance of a good outcome and a 65% chance of a bad one. Shutting down the division immediately costs the company about $182 million in expected value, but waiting 1 year before deciding, giving the division a chance to prove itself, actually creates a $14.5 million in value. That flexibility is what makes real options analysis so valuable. This slide covers two related issues. First, efficient market theory. Once Berkshire's interest in PCC became public, PCC stock should have rapidly adjusted toward the offer price, while BRK stock might dip slightly as investors price in deal risk. Second, an ethical scenario. If a BRK employee who also holds PCC shares considers buying more BRK stock on this news, that raises real insider trading and conflict of interest concerns, requiring full disclosure and abstention from related trading or voting. Separately, I evaluated two bond portfolio options for a 5-year duration target. Portfolio 2, which pairs a T-note with the longer maturity T-bond, has higher convexity, meaning it holds up better against interest rate swings, along with a slightly higher weighted yield. For an investor looking for a safety net, Portfolio 2 is the stronger choice. To summarize, this analysis supports 4 key conclusions. Acquire PCC at $235 per share, finance the deal with debt to capture the tax shield, delay any decision to shut down the underperforming aerospace division by at least a year, and favor Portfolio 2 for fixed income exposure. Together, these reflect Buffett's broader philosophy, paying a fair price for a wonderful company and structuring the deal to maximize long-term shareholder value. Thank you for watching, and please look forward to new videos.